Welcome to the foundational course on understanding the market profile. This preface or prologue is one that you may want to refer back to from time to time, as it is much deeper and more complex than it appears on the surface. Its depth will become clearer and clearer as you study, gain experience, and interface with the market. First, let's make a clear distinction. We are not profile traders. We are discretionary traders utilizing the market profile. The market profile gives us a visual way to see the continuous two-way auction process in an organized fashion and allows us to observe the market's structure. Let's clarify what we mean by being discretionary traders. In discretionary trading, each trader decides which trades to take based on their read and understanding of the current market conditions. The opposite of discretionary trading is systematic or rule-based trading. Under rule-based trading, a trading system determines which trades to make regardless of how they see current market conditions. Most traders spend many years seeking out systematic trading systems as they see this as a way of relieving the psychological pressures that trading introduces. If a true trading system existed, you and I would not have access to it as it would have been bought up and coveted by a wealthy trader or a trading company years ago. Over the years, you will constantly be subjected to many claims regarding successful trading systems. Most traders are constantly drawn to technical analysis. Technical analysis may include price momentum indicators, moving averages, RSI or relative strength, momentum oscillators, and moving averages, etc. Technical analysis is based upon price. As you will shortly see, the market profile employs three components: price as an advertising mechanism, time as the regulator of all advertised opportunities, and volume measuring the success or failure of all advertised opportunities. Without employing technical analysis yourself, you may be able to identify opportunities based upon what others are doing. The most common form of trading is based upon price momentum. The basic weakness behind price momentum trading is that traders take it to the extremes. These extremes occur as the basic herd instinct affects most traders. Discretionary traders, however, recognizing these extremes, have a great advantage. One of the most common mistakes we make is to be over-anxious to make our first trade. Trading before you have a good foundation can lessen your chances of developing a healthy, positive psychological attitude. Learning how markets operate is important in dealing with the psychological challenges you will face down the road. Successful trading is a composite of market understanding and self-understanding. Your first goal should be to develop market understanding. Each of the sessions in the introductory course will be divided into 3 unequal portions. One portion will be on daily preparation, another, being the most prominent, will be on understanding the market's continuous two-way auction process, and 3, providing a look into immersion trading. Immersion trading will allow you to gradually get a sense of how real markets trade. Let's begin our course with an introduction from Jim.
Back in the early 80s, when electronic or screen-based trading was just around the corner, J. Peter Stottlemyre, an active floor trader, as well as a graduate of Stanford University with a major in statistics, began to conceive of a better way to record daily market activity. Historically, activity was portrayed via a daily bar chart. The 4 data points on a daily bar chart are the open, high, low, and close. Bar charts are linear and do not record the true extent of market activity. Specifically, volume and the time spent at different levels are not recorded. Using his training in statistics, Peter set out to develop a more statistical approach to recording market activity. Scientists have historically observed and studied data by organizing it under a distribution curve. To form a distribution curve, you need a constant and a variable. Stottlemyre made the observation that time could serve as the constant on the horizontal axis, the amount of time between 7 and 7:30 is equal to the amount of time between 7:30 and 8, with Monday and Tuesday being equal in time. Price, the variable, would then be placed on the vertical axis, completing the final requirements for a distribution curve. At this point, the market profile was born. We would still have the open, high, low, and close shown on the daily bar chart. In addition, we would now know how much time was spent at each price level. Around this time, a mutual friend had noticed some distribution graphs on my desk and suggested that Peter and I should meet. A couple days later, Norman brought Peter to my office in the Chicago Board of Trade. Within a few minutes, I recognized the brilliance as well as the simplicity of Peter's observation regarding time and the formation of the market profile. Peter left my office to get on the elevator to return to the trading floor. Instead of getting on the elevator, he turned around, walking back to my office, asking me if I wanted to sponsor his first book on market profile entitled Markets and Market Logic. I asked him how much, and he replied $10,000. I immediately wrote a check. You will see on the outside cover of Markets and Market Logic the sentence, sponsored by J.F. Dalton. My early legitimate association with the market profile was established. You recall that the development of the market profile took place as markets were transitioning from floor-based trading to electronic screens. Prior to electronic trading, orders were executed via open outcry. These orders came to the floor either via teletype or telephone, then sent into the pit via hand signals or on paper. Sound was the most important way short-term traders gathered information. When buying or selling was increasing, the noise level from open outcry rose. As activity began to slow down, the noise level dropped off. Off-floor short-term traders were at a distinct disadvantage. The transition to screen-based trading greatly increased transparency, helping to level the playing field. The market profile, which is a visible distribution curve, gave additional structure and visibility to the market, enabling knowledgeable short-term traders to take greater advantage of the new transparency. The constant bids and offers arriving from all over the world create a continuous two-way auction process. The market profile captures this continuous two-way auction in a visible format. The remainder of the foundational course expands on constructing the market profile, introducing the nomenclature associated with the profile, and beginning to interpret the profile for trading. Okay, let's take a look at Lesson 1, which discusses the continuous two-way auction process. Let's review the auction. There are three components to the auction: price, which advertises opportunity; time, which regulates all advertised opportunity; and volume, which measures the success or failure of the advertised opportunities. One of the things that will be most difficult to really gain an understanding of the educational program we're in will be the ability to focus on value, which we'll talk about in a minute, and not be focused on price. Remember, price is simply an advertising mechanism. We said earlier that the market operates by a continuous two-way auction process. Most of you are familiar with either an art auction, a farm auction, or something of that nature. Let's just review an art auction. The auctioneer comes out, and let's say he's got a piece of art and he wants to get the bidding started at $100,000. He says, who will give $100,000, etc. If no one lifts the bid at $100,000, he will then drop the price to say 97.5, 96, and maybe he drops it all the way down to 95. At 95,000, the auction gets underway. Now, what happens in most cases is the auction, from the time it gets started, starts to pick up steam. You'll hear, I have 97, I have 97 and a half, I have 98 of it, 99, I have 100, I have 101. So the auction now has moved back through the initial 100,000 that he couldn't get anybody to lift the bid for to start with. There's a certain psychological thing that takes place once an auction gets underway. It seems like nobody really wants to be first, but once the auction gets underway, everybody wants a part of it. And this is really how prices are distributed, or the bids and offers are distributed on the stock and futures exchanges. You know, sometimes it's open, it used to be open outcry, now it's electronic, but it's the same thing. So in this case, the art auction, it goes from low to high. Now, two things can happen once the auction gets underway. In most cases, as the auction starts, prices start to go higher, you will hear the auctioneer begin to put fillers into the process. So he may get it 110,000 and it's going very slow, and he'll say, who will give 110,000 for this wonderful piece of art developed by so-and-so in the 1700s? And so when you hear the fillers being put in, then you know that it's late in the auction process. It may not be over, but it's getting late. Now, another thing may happen. As the auction gets underway at 95,000, as it gets above the 110,000, instead of the auctioneer putting filler in, you may hear him say new bidder. When he says new bidder, that means that higher prices are actually bringing in more activity, not cutting it off. This is something that you will see quite often in the stock and futures market. It happens when, say, the prices pass some kind of technical level or some breakout from a balance area or previous monthly highs or lows, etc. And you will see this market accelerate. Now, in the art auction, we go from low to high. In the stock and futures markets, we go from low to high, and then we go from high to low. The same process as the market is going lower is what took place as the market's going higher. Within each auction, there will be some information conveyed. That's what an auction is about. The profile, the market profile, is the device we use, or the tool we use, to record the market's continuous two-way auction process. Once we have a profile, it gives us a visual representation of the market. This market profile gives the market structure. Reading and interpreting that structure is one of the elements that gives us an edge. You will very often hear that a trader without an edge is a trader that will not be successful. Recalling back when we first started talking about Stottlemyre and the development of the market profile, one of the things that he discovered, we said he was a major in statistics at Stanford University. Being a major in statistics, he was very familiar with distribution curves. And he knew that a distribution curve requires a constant on the horizontal axis and a variable on the vertical axis. His observation was that you could make time the constant. The time between 6:30 and 7 is the same as the time between 7 and 7:30. So by placing time the constant on the horizontal axis and comparing price the variable to the constant time, you now have a distribution curve, or you have a scientific method of comparing time and price. Let's take a look and see actually how we would mechanically record a profile on any particular day. You'll see at the top that we have 9:30 to 10 as our first period. We'll call it A period. It could be any letter you want. 10 to 10:30, again, equal time periods. And then it goes through until we find a market close at 1:30. So in A period, if prices hit a low of 27.71 and a high of 27.74, we would simply record A periods letters on the left-hand side of the sheet. B period then trades from 27.71.75 on the low to 27.73.50 on the high. Well, B is what we would call an inside period. So you can see we're one wide at the high and single prints on the bottom, and then two wide in the center. As we go on throughout the day, you'll see that we just continue to record the letters from left to right. In C period, when the market extends below the original low at 27.71, trading at 27.70.75 and 27.70.50, you'll see C period is now on the far left. We record the period from 11 to 11:30 in exactly the same manner. As the day goes on, we continue to mechanically record the 30-minute periods in this manner. This is a market profile. The market profile is really nothing mysterious. It is simply, you construct it by simply taking the high and low of the 30-minute bar periods. When you get done with the profile, you'll have on the left, I'm showing here, a market profile. On the right, we are looking at the normal distribution curve. Now, the profile that we see in stock and futures markets will rarely be a natural or normal curve. It will almost always vary. But the normal distribution is our starting point, so we can begin to organize the information and have some idea what the distribution throughout the day looks like. The next thing we do is we make a calculation, and we want to see where 70% of the day's trade took place. Where 70% of the day's trade took place, we refer to that as the value area. Important thing is here, we want to be able to distinguish between price and value. By distinguishing between price and value, value helps us sort out some of the prices that were less significant on any particular day. The profile, as I mentioned earlier, is nothing more than constructing daily bars in just a different manner. On the left, you see the high and low of the daily 30-minute bars. On the right, you see a profile. You notice now that it's not a normal or distribution curve, and it will normally vary as we go out throughout the session. The most difficult thing for traders beginning to employ this methodology is to constantly be able to distinguish between price and value. Most traders get caught up chasing and trading price. Remember, price is only an advertising mechanism. Our focus is on distinguishing the difference between price and value. We're going to be talking about value. And as you can remember, we trade value, not price. Price is simply an advertising mechanism. Being able to monitor developing value begins with focusing on the POC, or as you remember, it's also the fairest price at which business is occurring or being conducted. Successful trading is creative problem solving. Imagination is required in visualizing how value may migrate lower or higher, or if it's unlikely to change. This keeps us in touch with the possibilities of change as the day progresses. The test question: what would change the POC? Remember, the POC is the longest line closest to the center of the range. If there are several equal lines closest to the center of the range, 2 ticks in range extension would change the center of the range by 1 tick. Remember, the center of the range is going to be halfway. 2 ticks of range extension, either up or down, would change the center of the range by a tick. And if the POC is at the center of the range, then it could change if there's several equal lines, that could pull the POC higher or lower. Time can change the POC. If over time, one line becomes longer and longer, the POC will change. If the original POC becomes wider and wider, the odds of change diminish considerably. As you get experience, you will be able to see the potential for the change in the POC and the potential for the change in value. That is where the imagination comes in. You don't want to just focus on what's happening right now. You want to be able to project to what could happen as prices move up or down, as the POC moves up or down. Sometimes we get a day that we call a double distribution. A double distribution occurs when the original area in which trade is being conducted gets overwhelmed by price moving sharply upper or lower. And at this point in time, if there are single prints left between the new distribution and the lower distribution, we now have what is called a double distribution. In a double distribution, we look at the POC that develops in the new distribution rather than the first. Now, sometimes you'll have a double distribution, and as the day goes on, price will come back and close that distribution. If it closes and you get one single distribution again, then you focus on the POC for the combined distribution. Another key point is on trend days, there is no POC. And this misleads a lot of people because they get focused on the POC and then they get a trend day and they start following and looking for the POC. It is not relevant on a trend day. Sometimes a trend day will go from very calm in the morning to all of a sudden begin to trend. When it goes from the very calm area or the balance area and it begins to trend, then you want to give up looking at the POC. Sometimes just the opposite happens. The market will start out as a trend day and it will move, very quickly, either up or down. If the market then finds balance and you start seeing the market rotate back and forth, then you go back to focusing on the POC. It is not uncommon for markets to act in that manner. The market is always looking for a level where two-sided trade can take place. Trading is a business. Trading the market is related to a business. You have inventory, you accumulate inventory, you get rid of inventory, you have profits, you have losses, you have taxes. So it's a business like any other business. Any good business, nothing really significant happens until there's two-sided trade. So, you've got buyers and sellers, gives you balance. So you're always looking for that to happen in the market. If market starts out a trend A and then converts to balance, which we just talked about, remember, you then revert back to monitoring the new POC. Looking at an example of lower value. Deliberately, we picked a relatively difficult day. You can see that the 16th, 17th, and 18th were all trending higher. At this point in time, traders that have watched the market trend for 3 days are in the habit of buying breaks and selling rallies. So it's an upward trend. The logical thing to do is buy breaks and sell rallies. When you come into the 19th, you'll see that the market opens near the lower end of the 18th. The green dot on the left is where the market opened. So once the market opens down there, you start focusing on value. You say, wait a minute, don't focus on price. Let's see if value builds higher or lower. So A period has a very wide range, very wide range. B period is inside A period. So that's calmed down. In other words, it's found an area where two-sided trade can take place, at least for that period of time. Notice now that we've now spent an hour below value from the previous day. C period breaks lower. Traders that have been accustomed to buying breaks and selling rallies have a problem in this day because the market's been going down. Now, then you get D period, E, F, G, and H, and we all spend time below the value area of the previous day. So as we spend more time down here, it gets harder and harder for value to change. So in this point in time, remember, we had one type of trading when the market was trending. Now, on a day like we're looking right here, it's a balanced day. It's trading back and forth, and it's rotating back and forth through the opening. Now, you want to be able to buy breaks relative to this day and sell rallies relative to this day. Trading with value. If value is lower, then you want to be able to focus on what would you do with lower value. You'll buy breaks, sell rallies, but you always want to say that keep in mind eye on value. Now J period runs up and takes out the A period high. And what happens if you're trading, that can get you all excited because you still remember the last 3 days have been up. J period does not carry through, and K, L, and M come back down. Remember, it would have been very hard for the point of control to change in J period, because if you look, it's A, B, D, E, F, G, H. So it's already 7 wide at that point in time. Use your imagination and see how hard it would be for value to change. If you see that and recognize that, there's lower odds that you'll get caught buying the market in that J period rally. Okay? We deliberately selected a very difficult day on that day. And part of the reasons I point out that the market had been trending higher before this day when it started to bring the market into balance. It's hard for traders to control their emotions. So this day was counter to what they've been doing. And you will find as we go on, emotions are a particularly important, potent way to make you a good trader or a bad trader. We talked about most of this in this slide. You can come back and review what we talked about the other day, or just, in the last slide. You don't want to get caught on the long side of this market unless it's a very short-term trade. And you want to position yourself on this type of day to trade from the short side. You want to trade with value. That's just a recap of what we just got done saying, but this is important to understand what went on that day. So we talked about this slide. Now go back, and this is just another way to review what we were covering. Sometimes we get overlapping to higher value. This is a particularly difficult day for some. In C period, we had a pretty sharp break. So A period, B period, back and forth from the high of the previous day. From the value area high. Then C period breaks. C period breaks pretty hard. And notice the green circle on your left is the unchanged level from the previous day. So not only is C period trading down into the previous day's value, it is also showing a negative because it's trading below the closing price from the previous session. Easy to get caught in there, but if you're focusing on value, you ask yourself, what would it take to change value today? What would it take to get overlapping or lower value? It would take time spending a considerable amount in and below the value area for the previous day. That's getting high as you go A, B, C, D, E, F. You're 2.5 hours into the day, and it's very unlikely that you're going to spend enough time in the value area from the previous day to get lower value. So what happens with that information? If you have that information, and again, using your imagination, you don't get caught on the short side of that market. Then the market after C period makes an excess low, excess meaning you have single prints. So from the excess low, the market one time frame higher for several periods. One time framing means that D period did not take out the C period low, E period did not take out the D period low, etc. So the market one time frame higher. Then in I, J, and K period, the market started to come into short-term balance. Remember, the market is always looking for a place where two-sided trade can take place. We came out of that two-sided balance area in M period, L and M period, and broke lower. But notice when we got all done, value was still overlapping to higher. So you didn't want to spend a lot of time on the short side of this market. You wanted to be on the long side. Buy breaks and take profit on rallies. This is an example that we put in as we were making the slides. It's a day that happened, and I was trading this day at the time. So he said, let's use this example. And what is so important about this example? Notice that A, B, C, and D period all traded lower. Now, it's lower is below the low of the previous day. It is just about unchanged on price. Remember, price is the green box on the left. But for 2 hours, A, B, C, and D, traders saw the market being sold every time it rallied. When you see price doing that, it is very easy to get trapped by it. I watched this day, and my instincts kept telling me to go short, go short, go short. I kept looking and I said no, because value is going to be higher today. We weren't even in the previous day's value area. So by focusing on value, I didn't get caught on the short side, but yet my emotions wanted to short the market. 2 hours, you see the market go down. It may be hard to get that feeling as you're watching a presentation that's on, recording, and you're not there at the moment to feel it. But I will promise you that when you see the market try and trade lower for 4 hours, it does have an effect on you, and it is easy to become misguided. And so resisting the temptation to get short and understanding the trade was the upside would help, very helpful. Now, it didn't do a lot on the upside, but it did, go and trade higher for several periods after the C period low. Or another way to look at this, another way we trade sometimes on a very short-term basis, if a market breaks out of balance from an inside bar. So you'll see D was an inside bar. It's an inside bar because the low did not go below the low of C period. The high did not go above the high of C period. And when it comes out of short-term balance, sometimes that's a good trade for a very short-term trader. But this was a particularly difficult day. It's a good day to go through and understand what I'm talking about on the emotions. A nuance in here is if the market opens within the range from the previous day, there's a pretty good chance that we're going to have a rotational day. Rotation just means, we're going to make some moves up, we're going to make some moves down, and it's a good day for looking for very short-term trades. And if you understand that it's an inside day and you see a good short or you see a good long for a short-term trade, you don't get yourself believing that, oh, wow, this could be a really good trade. It could be a good short-term trade, but that's all there is to it. Sometimes we get ourselves thinking, oh, there's going to be more to it. This keeps you in perspective. So if you open within the previous day's range and you stay there for at least an hour or so, chances are pretty good it's going to be a rotational day. And that is very helpful. Or you'll see days that say, wait a minute, we have a trend day. The market just continues in one direction. About maybe at the most, 10 to 15% of the days are trend days. The majority of days, about 85%, they're rotational days. That rotation can vary from time to time, but keeping that in mind, keeping value, always focus on where is value developing, will help you keep a really good perspective on the market. And not only by keeping a good perspective, it really helps keep your emotions under check, and that is extremely important. So these are just concepts that you need to, put together. Now, what's going to happen? Some of these things you can memorize. The nomenclature that we talked about earlier, you can memorize. You can't memorize developing value. You can memorize the basics, but getting to the point where you can follow the POC or fairest price at which business is being conducted and really understand where value is likely to be is going to take some time and experience. Just like we said, it was very difficult to get yourself to focus on value, not price. We can't teach you not to focus on price. We can tell you, we can talk about how do you do it by focusing on value, not price. But making that transition is very difficult. It's easy, you can memorize the point of control, but how the point of control can migrate higher or lower and being able to visualize how value could change as the day goes on. Could value move higher, lower? Is it unlikely to change? Those are things that take a lot of experience, but they're extremely important if you are going to be a competitive trader as time goes on. So we said here, you're continually asking yourself, what would be required just to get unchanged value today? What would have to happen to get overlapping to higher value? What would have to happen to get higher value? What would have to happen to get lower value or overlapping to lower value? These are important concepts that will help you stay focused. Do they guarantee you a profit? No, they don't. But they will certainly bring the odds around in your favor. Generally, it's a generalization, but you want to trade in the direction of developing value. The day we looked at, just a slide back, where the market sold off for the first 2 hours. If you kept looking at where value was going to be, and you say value is going to be higher, the trade was to buy the breaks on that day in those first 2 hours with the idea that value was going to be higher that day. That was a great example of being able to trade with developing value gives you a much higher percentage of wins. Doesn't guarantee it, but it will help filter out some of the bad trades. Anchor trader or developed trader. These are two types of traders that we talk about. What some of you that have been familiar with this, we are changing nomenclature. We used to call an anchored trader a fast trader. We used to call a developed trader a slow trader. That those terms didn't communicate with people. So now we're calling an anchor trader or a developed trader. And in just a couple of minutes, I'm going to show you what I mean by anchor. Anchor trades are a substitute for scalping. So many times, and I've said this before, only about 5% of the traders that came off the floor were successful going to screen-based trading. A lot of the things on the floor were scalping. And they come off and they try and teach scalping to off-floor traders. And off-floor traders think it's really sexy. Well, it doesn't work for off-floor traders. Let's look at the next slide. The anchoring effect is a cognitive bias whereby an individual's decisions are influenced by a particular reference point or anchor. Once the value of the anchor is set, subsequent arguments, estimates, etc., made by the individual may change from what they would otherwise have been without the anchor. The anchor is artificial. It's something that they see it, they make it as value or valuable in their mind, but in fact, it isn't. That is very valuable information, and we're going to see that very shortly. Okay, let's take a look at the next slide. Traditional anchors, half back relative to the entire session, half back relative to the prior 30-minute bar, previous day's high or low, half back from the previous day's range, half back relative to the overnight range, prior prominent, very prominent points of control. Additionally, prior weekly highs and lows, monthly highs and lows, along with highs and lows of unfilled gaps, also serve as anchors. From astute observations, you will continue to observe anchors. Let's look at the next slide before we make this real. Traditionally, scalping was a term identifying trades employed by floor traders. Floor traders had a distinct advantage in that they could buy on the bid and sell on the offer, which is the opposite of what you and I do as retail traders. When we buy and sell, we lose a tick going in and a tick going out. The floor trader didn't always do that because he could buy on the bid and sell on the offer. We have to do just the opposite. That is a tremendous advantage. Additionally, because floor traders helped exchanges build liquidity, they enjoyed another advantage. Their fees and commissions were considerably lower than that for retail traders. So there was a tremendous economic advantage from being a local on the floor and trading on the floor. I used to clear locals. So this is something I was a local. I cleared locals. I have a very high familiarity with this and what goes on. Okay, let's look at the next slide. Non-floor retail traders, without fully understanding scalping or enjoying the economic advantages of a floor trader, attempt to employ scalping strategies. Scalping to these traders generally refers to attempting to make a few ticks by reading and interpreting order flow. Even if these traders were not at an economic disadvantage, the selling of order flow by many of the broker dealers to large institutional clients and hedge funds further disadvantages them. A lot of traders think oh, I look at order flow. Well, these large traders, these large hedge funds and institutions are getting a microsecond look ahead of you with these very high-speed computers. And if there's anything to be learned in the order flow, they're taking it first. They're making billions of dollars. They only make pennies per trade, but it adds up to billions of dollars. One firm in Chicago spent, this is absolute truth, spent $1 billion to put a phone line directly from Chicago to where the trades were cleared in New Jersey in order to get microsecond advantage from that. And that turned out to be a good investment. Again, what I'm trying to show you is some of the realities of what's going on. And some of this is going to upset you because you've been looking, I have people all the time, so I buy or sell, look at order flow. Oh yeah, no, I like order flow. And people teach order flow. They charge you money to come teach how to read order flow. Well, there's people ahead of you with big fast computers and they're buying, I literally mean milliseconds head start. That's all they need with the high speed computers. It doesn't work. There may be, for some people, what I say, if it works for you, continue to do it. If you're doing it and you're not profitable, you've got to rethink everything. Let's look at the next slide. By paying for order flow, large institutional clients, I've just talked about this. So the same thing, milliseconds, but it adds up. Anchor trade or develop trade. The personality of an anchor trader. Decisive, no attachment to any trade. And I'm going to clarify that in a minute. I'm going to show you some real examples. The anchor trader is very decisive. They're very quick. They don't overthink the situation. It either works or it doesn't work. The personality of a developed trader is more reflecting and calculating. The developed trader, in many cases, will use the information gained from what he or she sees the anchor trader do in order to think in terms of odds and probabilities to do their developed trade. We recommend reading Daniel Kahneman's book, Thinking Fast and Slow, to get a better understanding of how different people process information. He uses the term fast and slow processing. Neither one of those is necessarily negative or positive. It's not negative to be slow processor. It's not positive to be a fast processor. They're simply the way some minds work. One of those is not negative, one is not positive. It's just a simple fact of how he finds minds work. It is a very meaningful read. A lot of people get involved in trying to do trades that they're not mentally equipped to do. It's just not the way their mind works. I am not a fast trader. Do I understand, or an anchor trader? Do I understand anchor trading? Yes, I do. Am I good at it? No, I'm not. It's just not the way my mind works. I can explain it to you. I can point it out to you. I use the information in order to focus on developed trades, which are more reflective and calculating. Both anchor traders and developed traders can take advantage of the opportunities presented on the same day. For example, an anchor trader might buy the early break to a single tick above unchanged settle and again just above yesterday's low. Developed traders who are more reflective might go to the next time frame and using that same information make a different decision. Developed traders might see these lows as weak and expect them to be taken and sell the rally. I'm going to show you this exactly in just a couple of minutes. It comes down to what personality you are. Are you someone that is a fast thinker and can make quick decisions? Can you exit a position quickly without hesitation if it's not working? That's a personality. Let me try and put this in some perspective. Jen, can we go back and let's replay the early trade this morning, please? Okay, so we're going to replay this morning, and we're going to replay at, we're going to start off with 5 times normal speed. So reflect on, remember where last is, remember where the settle is, and remember where yesterday's high is. Okay, so we had news this morning, and prior to the opening, the market was trading up on that news. Okay, stop for 1 second. The first anchor you see is the market traded exactly or within a tick of yesterday's high. That is an anchor. Traders went exactly to that level and they bought it. They think that's value, or they think that's a really, attractive place to buy. They've established a value on that that's unrealistic. The odds, when I see that mechanical exactness happen, the odds are very high that we will come back through that mechanical reference. That would be considered a weak reference, and it's a weak reference because it was within a single tick of a prior high or a prior reference. So this is a weak low this morning. The A period low is weak. Now it's good because there's single prints, but it's weak because it's within a tick of yesterday's high. Jen, continue to play. Okay, so you saw the market come back down through that, okay? Remember, we said the odds were pretty good. We would come back down through that, and we did. Okay, now stop again, please. Short-term traders, it's tough to read these markets. But if you look in the volume, when it looked below yesterday's high, white is the lightest volume, red is the heaviest, and pink is medium. So the market did come down and take out that anchor, traded down on low volume, and then bounced back to the upside. Okay, so that low volume at that moment in time suggested we were going higher. Okay, continue to play. Remember, we're at 5 times normal speed. Stop a second. Notice 2 or 3 times the market came down exactly to the overnight high. You need, when we talk about chunking, you need to observe that. Came exactly to the overnight high and they bought it 2 or 3 times. That is another indication that the buying that we're seeing in this market this morning is weak because they're buying exactly at another reference. Okay, continue to play. Okay, so you see we did come back down through that, right? Okay, so the market breaks. They bounced it again from just about yesterday's high. Stop a second, please. Once you re-enter a previous day's high, pretty good odds that you're going to do some very serious damage to the other side. Okay, continue to play, please. Keep your eye on last. Watch last. Okay, one more time. One tick below last. Last is weak, good odds we're coming back through it. Okay, stop, please. Now, when I look at all the information as of right now, one, we looked above yesterday's high and we came back in. That always gets my attention. That good possibility that we do some more serious damage to the downside. Doesn't have to happen. It's one piece. When we're talking about chunking, it's one piece. We looked above yesterday's high, we came back in. Second piece of chunking, the initial reference that we used was the high, as I think that was our initial anchor, and the market bounced from that, then came back. That's weak. So that's two pieces of chunk. Now, the market has come back in. It came back in also into the overnight, looked above the overnight range and came back in. Another negative. Now, the next piece of negative in here is the last. So we got a chunk. It's an anchor. It is an anchor because it looked exactly at the half at the last trade from yesterday. And we said the CME puts out last and settle. Traders use both of those as anchors. So now we're looking at this and we've got multiple pieces of information that form the chunk that this market is weak. All right, let's continue to play, please. See, traders, they're buying it again at last. Look at that. How many times they're buying it at last? Note that's weak trading. So we've taken that, we've taken that out. Now, the next thing they're going to be looking at is the overnight point of control. It's 15 wide, and we said the more prominent an overnight point of control is, the greater the odds it will be revisited. The next lower reference will be that and the settle. So you see it one tick above the overnight point of control. That's another anchor that they've used. When I see constant buying at these anchors, that is short-term traders. Now, let me stop 1 second, please. Here's where different personalities come into play. For example, when it went down to the overnight point of control, one tick above it, an anchor trader, you can make an anchor buy there if you want to do trades and you're very quick, you're very decisive, and you understand the personality and you understand the odds are pretty good that these short-term traders are going to buy there. That's what they see. Oh, they're looking at they're making that a value area, not value like we talk about during the day, but they're seeing that as, boy, that's just that's a great buy there. They've established that as being value in their mind. It's not realistic, but that's what they do. Trading is understanding, short-term trading hinges so much on understanding the behavioral characteristics of those that you are competing against. So you got two personalities. One, for the anchor trader, can buy this trade knowing that the odds are pretty high that they're going to bounce. If the trade doesn't work, you have to be out immediately. This is why the personality has to be decisive. The developed trader, which I'm a developed trader, I'm using all this information about these anchors this morning, and I'm short this market. And the anchors are confirming what the short-term traders, the daytime frame traders are doing at these anchors, are confirming to me that my trade on the short side is the right trade. Okay, continue to play, please. All right, look one more time. Look at overnight half back. They did the same thing at overnight half back. One tick below it. Again, that is another anchor. So what we have a market that has looked above yesterday's range. It's come back in, and these short-term traders who still have it in their mind that all things are up, they're buying every mechanical reference. And remember, somebody said, why yesterday, why mechanical? Because you can see them. You can see, we already identified half back from overnight as an anchor. Prominent point of control overnight as an anchor. The last as an anchor. The settle as an anchor. The previous day's high is going to be an anchor. The overnight high is going to be an anchor. What you're seeing here is what these short-term daytime frame traders are doing at every one of these anchors. The developer, I'm using this knowing this, I'm saying these are the weakest hands traders when they're buying at these artificial or mechanical levels. Those are the weakest hand traders. That is confirming to me as a developed trader that I want to be on the short side of the market. All right, this is as far as we're going to go.
I was just going to interject and just reiterate. So, Jim's given you wonderful examples of how, just from this morning, how both types of traders could have used the information differently and taken trades. So
absolutely. When we talked about these anchors this morning, think about how many of these short-term traders bought one anchor, got stopped out, bought another anchor, got stopped out, bought another anchor, got stopped out. You ever had a day like that? And then you get stubborn and you buy it every time it breaks and you get stopped out. I'm going to guess out there the short-term trader's been stopped out 3 or 4 times this morning, and they missed a great opportunity on the market to the downside. Also, when you look above a previous day's range, you always have to be alert for the market to trade to the opposite extreme. All right, we've covered a tremendous amount of information in a very short period of time. This is what you have to learn to deal with if you're going to be a successful trader. Is it hard? You're damn right it's hard. It's hard emotionally, but the first thing, it starts with market understanding, then you get the chunking so you can see what's going on, and then it becomes self-understanding. It's not easy, and it takes time, and it takes experience. Successful trading with experience has a lot to do with nuances. One of the nuances that we cover every time that we do a preparation or a replay is overnight inventory. I was surprised when I began talking about inventory. I've not heard anyone else talk about it, and I was amazed at how many senior traders were not aware of the impact. And maybe it is that other markets that are all electronic, it's really hard to get your hands around the inventory. When we're trading the ES, or markets that we can actually see the overnight inventory and measure it fairly correctly, it is an important consideration. So the first is, and we've written this down because people always have trouble remembering this, but it's important to listen to what I say. Just use what is written as a checklist. Okay. Overnight inventory occurs relative to the settle price, or also the unchanged price from the previous session. If overnight inventory or overnight trade occurs above the settle price or the unchanged from the previous session, then overnight inventory would be considered long. If overnight inventory trades below the settle from the previous session, overnight inventory would be considered short. Now, it's not always that clear cut. that it's either 100% long or 100% short. If it's basically balanced, which is about the same amount, of trade above and below the settle, then don't worry about overnight inventory. When you are interested is when it's clear that overnight inventory is either long or short. If overnight inventory is long, for example, approximately 65% of the time, and that is an anecdotal number. It's not something that I have scientifically measured over extended periods of time. But if overnight inventory is long, the expectation is that we will adjust overnight inventory. How would you adjust long overnight inventory? You would see some selling. That selling is also referred to as a counter auction. If overnight inventory is short, the odds are we would expect a counter auction. A counter auction to short overnight inventory would be a rally. One of the most misleading events occurs when you have a correction or a counter auction to overnight inventory, and you mistake that counter auction for a more sustainable move in the underlying security. So for example, if overnight inventory was short, the expectation is for a counter auction or a short covering rally. If that short covering rally occurs and there's no upside follow through, all you had was old business. The covering of short positions is considered old business, just as the liquidation of existing long business is considered old business. If you have a counter auction to short overnight inventory and there's no follow through, then that correction to overnight inventory weakens a market. The big mistake comes when you're following price and you mistake that price movement to the upside, which is old business, for something more substantial. Likewise, if overnight inventory is long and you get liquidation, which is old business, not joined by new business, but you mistake that liquidation as a weak market, then it is a very difficult day for you. It's important that you think about and understand overnight inventory in each session. It's a nuance. And it's important to understand, if you don't get the expected reaction, that also is very valuable information. The counter auction is up. You expect to see that counter auction to the upside, and instead the market trades lower. The information you're gaining there is that the market was fairly weak because it didn't correct that inventory. Likewise, if overnight inventory is short and the market doesn't rally, that's a market that's fairly weak. Overnight inventory is long and the market doesn't break, that's a market that's fairly strong. Go back, review what is written here, and every time you do your preparation for a market, think back and reflect on the importance of overnight inventory.